today what I want to do is focus on basically the two types of structures that you can have for purchasing a business. So the first type is to do an asset purchase agreement. What an asset purchase agreement is it's an agreement whereby you're going to go in and you're actually going to purchase the assets or specific assets of the business. So assuming you're purchasing the entire business, then you're purchasing all of the business's assets. So all of its goodwill, its website, its phone number, its tangible personal property. So, any type of furniture, fixtures, equipment, you're basically purchasing all of those assets and you're pulling those assets from the business into your business. So from that LLC or that corporation into your LLC and your corporation, that's who will own it. So the assets are owned by the business that you're buying the assets from. And then after the sale, you're going to own them. The other way to structure it is to do a membership interest purchase. So if the business is owned by just one or a few people, or even a number of people, all of who are willing to sell their ownership in the business, you can go in and do a membership purchase. Or if it's a corporation, then you would purchase all of the stock of the company. And so basically what you would do through a membership interest purchase or through a stock purchase is you would go in and basically purchase the ownership of the company, and you would then step in to the company as a going concern. You would then basically run the company as it presently stands, which includes its ownership of all of the assets, but it also includes all of the ongoing or current liabilities of the company. So if the company has debt, whether known or unknown, tangible or intangible, but any debt that's out there, you would basically step into that, and the company would still owe that. Now, you wouldn't personally be liable for that unless you actually, took over a guarantee or assumed the debt, but nevertheless, you step in to the business as a going concern with all of its assets, but with all of its liabilities. The advantage, though, of purchasing a membership interest is, let's say there's employees and there's payroll. In that case, you can basically keep those systems in place. The bank account can remain in place. You just have to change the signers. All of the payroll can remain in place. You don't have to, redo all of the payroll records and documentation and bank statements. Versus an asset purchase agreement, if you pull the employees over to your business, you have to do everything and set all of them up again with new payroll information. Find a payroll company, log all that information in. The other advantage of a membership interest purchase versus an asset purchase is, let's say you have companies that already have built-in payments coming to you. So your customers, your clients, they already have everything updated and scheduled, and there's regular payments being made by them. Well, if you step into the ownership of the company, well, those will continue. But if you're purchasing the assets, well, then you have to notify those customers and those companies and say, hey, look, I know you're making regular payments to me, but here's my updated bank account information, and here's what you need to do. And you have to change all of that then as part of the asset purchase. However, the downside to the membership interest purchase and the benefit of the asset purchase is what I was talking about with debt. If you purchase the assets, you can purchase them excluding the debt of the company, assuming you pay fair market value for the assets. So assuming you pay fair market value for the assets and it's not an insider type transaction, it's a bona fide arm's length transaction, and you purchase those assets, you don't have to assume the liabilities. And the liabilities can remain with the company that previously owned the assets. So that's the real advantage of the asset purchase, is purchasing the assets free of the liabilities. Obviously, if there's liens and encumbrances on those assets, then that's going to come with them. But if it's just unsecured debt of the company, you can leave that unsecured debt with the company, but pull the assets off, and receive the assets.
I've always found it a little bit of a catch-22 on which approach to take, in that it it seems a lot easier to just buy the membership interest or just buy the shares of the company and just walk into a going concern, right? There's no resetting up anything. You're just buying the ownership interest and walking in. That can be it's not that easy necessarily to do that transactionally, but easier, it seems, and a lot less involved than the asset purchase agreement. The problem is the liabilities that potentially come with the other liability is, one of tax liability, that of, whether the company you're buying has paid taxes. But so it seems like most buyers opt for the asset purchase idea. Uh, but with enough due diligence, that's what it requires a lot, right? A lot of due diligence going
Mhm.
into the company and knowing the interest that you're doing. Transactionally, I don't know if you agree. I think it's a lot simpler.
Oh, a membership interest purchase or a stock purchase is much simpler than an asset purchase. It does require more due diligence, but it is easier on the back end to facilitate and arrange the transaction. Both can be done. Um, an asset purchase, you still want to do your due diligence, but you're especially to determine whether there's liens, claims, encumbrances on any of the assets you're pulling over. But there's less of a concern there, like you said, of unpaid taxes and those types of things, because you're pulling the assets free of uh, liabilities.